So this is follow-on dollars from the same angel investor into the same firm tends to get a lower rate of return. Right? So that has implications for your choices about dry powder versus diversification and all sorts of fascinating things. Now you'll say, the most common thing here is, well, but what if I only do follow-on investing with a good external investor in a new round? Interesting question. I don't know whether that's good or bad. In this data, however, it has no effect on that chart. Right? So it still suggests that that might be good money after bad. So the basic take from this data, take it or leave it, it is hindsight, right? All I can tell you is what happened. Don't you wish that I could tell you what was going to happen? But the basic point here is you should have a very, very high bar on doing follow-on rounds, right? And that might be a nice way to put it. Last thing, sort of related to this. That's the very last slide now, I'll stop talking. Venture capital involvement. About a third of the deals in this sample had VCs also get involved at some point. And what you see here that's really interesting is when VCs get involved, there's no difference in the overall rates of return on the deals that did or did not have VCs. But what's different is the distribution of returns. When VCs get involved, you see a more extreme distribution of returns, right? Where you see the failures bump up and the home runs bump up. And where there's not VCs involved, you see a much larger occurrence of those 1 to 5x type returns. It's a really interesting empirical picture of what I consider to be some of the most core decision we have to make as angel investors. And by saying we have to make, I don't mean collectively. I mean individually, each angel investor has different approaches that work. But there's sort of a competing strategy between capital efficiency, the idea that on $1 million of invested capital, I might get to a $15 million acquisition price and take the money and run, right? In which case, I don't necessarily need to go through all the rounds of fundraising. Or perhaps I want to try to go a more traditional route to scale that up and get to a very large acquisition or IPO, but I'll need to raise more capital on the way. The raising of more capital and the building of infrastructure might leverage the deal unless you get some higher failure rates. So VCs are somewhat happy playing that home run game, and so are a lot of angel investors. But not all angel investors, right? There's a really interesting picture of that capital efficiency strategy. So that's strategically what I think I know so far about angel investing. If those were on your sheet of paper, great. But there are at least 30 to 1,000 to 1 million more different things we can look at, right? So when I'm looking for the financial return stuff, it's not to peg that number, 2.6. You know, at the end of the day, who cares, right? Don't you just want to be in the right-hand column, right? So we're just trying to figure out what are some of the things that can lead us that way. So that's why I'm really interested in those sheets of paper there. So that's all I've got.